There's something brewing, and I don't know exactly what it is, but the market is behaving strangely. I have some opinions as to what's going on, but some folks are saying that the market is crashing inside out. Kind of like, this is maybe a weird analogy, but kind of like, have you ever gardened and had aphids suck the life out of your plants? There are apparently these like killer wasps that'll come land by the aphid, stab the aphid, inject a baby into the aphid. The baby wasp then grows inside of the aphid, eating the aphid from the inside out until all of a sudden, explosion. Sorry for the graphic, descriptive visual there, but somebody sent me a message and they're like, Kevin, there's this growing divergence between the equal weighted S&P 500 and the market cap weighted S&P 500. Basically, this is a way of saying that like Nvidia's going up and everything else is going down. There are two potential ways to look at this. One, you could say the true economic reaction to what happened this week data-wise isn't actually broadly being seen. Instead, we're just sort of writing it off as, oh, it's a risk-off sell-off. That's what we had in the market today. Now, why would I say that, mind you? Okay, well, mostly because Bitcoin's down about $3,000 over the last couple days, so shorting Bitcoin made sense on a day like today. We'll talk about that strategically in a moment. And you look at the QQQ, you actually see it ended up 0.5 percentage point, but look at the downs, and they're pretty remarkable. On the downside, you've got SunPower down 9.82%. You've got Embraer out of nowhere is down 5.7%. Enphase is down almost 4%. Vertiv, one of those derivatives of server installs, down 4%. AMC down 4%. C3AI is down 4%. SoFi is down 5%. Redfin's down 4%. Robinhood's down 3%. Tesla down 2.5% after the shareholder approval vote. All of these stocks are reminiscent of generally risk-on positions. So when everybody feels euphoric and interest rates are falling, usually risk-on rallies. Well, we had a great CPI report, a great PPI report, and quite frankly, we should be assuming that the Federal Reserve is more interested in pricing in some more rate cuts. In fact, markets right now, for the first time that I've seen, really since about January of this year, have started to price in more than 2 rate cuts by December. Now that's really interesting because previously we went all the way down to like 1.14 at one point. We were barely pricing in rate cuts anymore. And now we're back to over 2. This comes after the data we get, but an oddly hawkish Fed. So how do we put all of this together? We've got this divergence in the S&P. We've got this Tesla weird activity. We've got Bitcoin. We've got the sovereign debt crisis in France. We've got a lot of a mess going on. And a lot of folks are legitimately wondering, Kevin, this is strange. Help us make sense of this. And so while I don't know as, an expert exactly what is going on, I'm going to do my best. I'm going to mention that we are doing a quick 1 day, just because there's so many folks to process here, 1 day extension on the coupon code that we expired this Friday or Wednesday on CPI Fed Day. I didn't post yesterday. I've been overwhelmed. Sorry, there's a lot going on. This is my P&L in the Stocks and Psych group for this week, which is really exciting. That's realized P&L, but it should have been higher, and no guarantees, obviously, that my future trading results, which I send alerts for to those of you in the Stocks and Psych group, will always be profitable. I actually can guarantee that it won't be. You could lose a lot of money, but my goal is to provide perspectives. And one of the reasons I bring this up is I didn't actually make as much money as I thought I would on Tesla this week. And so I'm very surprised by that because the shareholder meeting was supposed to be a giant negative catalyst off of Tesla shareholders' backs. So let's break this down one by one. First of all, Tesla catalyst, supposed to be really positive, stock down. Odd. Why? Margins have bottomed. I think sales are bottoming for the company. 2024 will be your flattening period, and you'll be off to the races with growth again, quite frankly, making Tesla's valuation ironically look cheap. You could value them at a 1.67 PEG, and as long as you deliver about 3 million vehicles by 2026, a little more than 2.5 years away, you're at a $300 stock, really just pricing in a solid margin and none of the other stuff. Insurance, FSD, I just use a little bit of a higher margin to price it in. Optimus, you don't have to go that nitty gritty and try to price in Elon saying we're going to go to a $30-50 trillion company. You don't even have to do that to get a nice return between now and 2026. Hopefully, though. But why then, if the negative catalyst is gone, and I'll play my interview with Yahoo Finance at the end of this, where I talked about Tesla, why then would Tesla sell off? Well, it's a symptom, not of Tesla, but of this risk-off attitude that's going on. And it's an attitude that is amplifying central banks are about to break something. See, when we lose 695,000 full-time jobs and gain back 284,000 part-time jobs, we start wondering, maybe the Fed has gone too far and they don't even realize it yet. And I think that is the crux of the problem we're facing now. It's not the sovereign debt crisis in France, though the sovereign debt crisis in France, which, quick explanation of that, France has a lot of debt to GDP, like over 130%, I believe. It's either 115 or over 130. The elections in France have led to the belief that the country is either going to default on some of its debt or it's going to take on a lot more debt and have a less stable fiscal house, basically. Cut taxes, lower revenues, increase expenses, whatever the assumptions are. You're seeing widening spreads in the French bond market for these compared to other countries. That's a problem because some people view that as maybe creating a liquidity problem for an indebted country. And if a country can't get access to money, things start breaking. You start getting, all of a sudden, maybe the European Union is going to have to do something dramatic to try to save France, but then it stokes inflation again. Who knows? All that, all these big words and noise aside, the market is looking at things going, cracks in the jobs market, cracks in people's personal finance, cracks in France. This is all symptomatic. Banking crisis, right? Office real estate. This is all symptomatic of a Fed that's gone too far. And the Fed told us to our face, hey, we see the balance of risks between going too far and doing too little. Oh, really? You see those balance risks as so clear that you would rather give us a hawkish SEP than revise your SEP incorporating the last amount of data so that you could actually prove you're data dependent. How can you possibly say you're data dependent when you say, yeah, this new data came out, but we generally just don't revise our opinion after the data comes out? Well, which is it? Are you data dependent or are you not data dependent? So what you end up with is a market that goes, holy fook. We have a Fed that is so delusioned or delusional or deluded that they think they're balancing risks when we're looking around going, look at all of the problems we're seeing. And so what you really have is a risk-off sell-off that's coming as a result of the Federal Reserve's summary of economic projections on Wednesday. Remember, folks, one of the most critical pieces of it was the Fed telling us, hey, long-term, we think rates are going to be higher. Oh, and short-term, we think rates are going to be higher. In two places, they ignored data and said, rates are going to be higher for longer. Well, so you're telling us on one hand you're going to be data dependent, but then when cracks are starting to form and data's coming in better, you're not being data dependent, you're sticking with that strategy. So what sells off? Risk assets. Okay, risk assets are interest rate sensitive stocks, smaller cap stocks, growth stocks where the growth is a little more speculative. Nvidia, let's be clear, is a growth stock. But at least right now, the market values it as a non-speculative growth. People are like, data centers based on GPUs and CUDA will be the future. All NVIDIA, right? Whereas with electric vehicles, you have Elon, bad man. EVs may not be the future. China, China, China. Whatever, right? Those are sort of countervailing factors that you don't actually have at NVIDIA. And you are still going through a growth bottoming process in Tesla. It hasn't bottomed out yet, growth. So I think it has, mind you, but at least in the data we haven't seen it, or in earnings we haven't seen it yet. That's mostly because I think this interest rate offer is actually very good from Tesla, and I think it's working very well. But that's not going to eliminate the concerns that the broader market has. So it's much easier to go, okay, I want growth. What am I going to invest in? Well, NVIDIA is going up, so let's buy more NVIDIA. Okay, but what about Tesla, the growth stock? Oh, the growth stock that hasn't been growing its stock price for the last 3 years? No thanks. That's an overvalued car company. That's sort of like your general perspective of the market. So, and I don't align with that. Now, I'm not always right. But I personally think at some point, I don't know when, I haven't sold all my NVIDIA. I've certainly trimmed my NVIDIA at these levels, and I'm not actively increasing my allocation to NVIDIA. But at some point, we're already starting to see it, mind you. We actually talked to course member. Ooh, I haven't announced that here on the channel yet. Ooh, I'll have to do a separate video on that. But we did a course member live stream a couple days ago. And what we did, I think it was actually yesterday morning, what we did is we looked at NVIDIA server availability for H100s at under $4, and the trend is straight up. In English, these servers are becoming more and more cheap, which increases the break-even costs if you're going to build a data center, which makes it less desirable for you to buy data center chips, which increases the chance that orders are going to slow for NVIDIA sooner. So let me rephrase that. If NVIDIA is going to crash, the first thing you would see is more available server time. Separately, we are starting to see more available server time at lower prices. Okay, see where I'm going with that? Okay, now, with that, I suppose I really should just pull up that screeny really quick. Let me pull it up, because this is the kind of stuff I always like to give a sort of early perspective on to course members. And again, I'm sorry, I don't want to seem flippant with the expiration. The net price after a coupon code goes up over time. That's very, very simple. We're just doing a quick thing today to catch up on people who still want in before we remove the coupon code completely. And then all of a sudden, it's substantially more expensive to get in. So if you want lifetime access, get in before 11:59 tonight. Okay. And then everybody's off for the weekend, which is great. But take a look at this. This is the chart that I posted in Discord. Ignore all this red. Wrong thing. Okay, hold on a sec. I'm going to post in just a moment this chart in Discord, or that I posted in Discord. I want you to ignore for a moment all of the red. That's all sort of my note-taking and theorizing. But just know, percent of minutes in hour with on-demand availability for H100s, and the trend is clearly up. I added the red line, but you can see the trend is clearly up. All the other stuff is more like course member notes and stuff I talked about. Now, this is just one data point, and obviously the plural of, one is not like a guaranteed trend. So I could think of a more eloquent way to say that. But let's just make this very simple. The market is showing frustration over the Federal Reserve's reaction to really good data. The market's flushing out that, wait a minute, you said you're going to be data dependent, and you're not being data dependent. That pisses a lot of people off. Okay. So what happens? You sell off interest rate sensitive and risk assets. Now, what is one of the easiest risk assets to short? Bitcoin. Just buy something like BITI. That does not make me anti-crypto. That doesn't make me anti-Bitcoin. It makes me look and say, if risk assets are going to sell off, what is also going to sell off? And is immune to the fluctuations of company earnings calls or company announcements or NVIDIA going up, right? Like, if I shorted the Qs, I'd lose money today because Nvidia went up so much and the Qs are up. Obviously, shorting Nvidia is very, very difficult. I've lost money shorting Nvidia before. It's a bad idea. And I've told people regularly that even though it's desirable to short, it's a very, very hard stock to short until the downtrend starts. You're more likely to get burned before you actually start making money. And that makes it a really, really hard short, which is probably also why the stock isn't going down, because nobody wants to short it, because nobody wants to get hosed. But fundamentally, it should be going down at some point. I just don't know when that is, so I'm not going to touch it. So instead of shorting Nvidia, I just go short Bitcoin because it's immune to Nvidia. It's immune to individual company, idiosyncratic issues at companies or announcements, earnings, surprises, whatever. And it goes down when risk assets go down. If you look at the 1 hour chart of BTC, we are on a pretty solid downtrend right here. We keep hitting lower lows and we're getting lower highs pretty consistently. The trend is here. This is just on the hour chart. We got a double top at 71. So I don't know that there's a hurry, but if we're gonna have a risk sell-off, shorting Bitcoin and shorting Coinbase could prove profitable. Could. Not guarantees. Not a guarantee, not personalized financial advice. You could lose money. I know some people are asking me that, Kevin, weren't you buying a bunch of Tesla calls? I was. On Wednesday, pretty sure it was Wednesday. On Wednesday, it was either Wednesday morning or Thursday morning. I can't remember. It may have been Thursday morning. We did a course member live stream, and I'm like, I need to get out of my Tesla calls, not because I don't believe in Tesla and believe that this is a good catalyst, but because the momentum that we're seeing after the vote has been approved is not what we are expecting. So something broader is happening. So we're going to take profits. And when I say we, I mean me. I should just say I'm going to take profits. I don't trade for you. If you lose money, it's your thing, right? I just provide perspective. That's all I do. So I closed. I don't have any Tesla calls right now, which I want Tesla calls, but I'm grateful today I didn't have any Tesla calls because the darn thing crashed right at the open. Like, I went into this morning with 0 Tesla calls. And look at this. I mean, look at the lines. We're in no man's land. We just crashed down to my 82 to 183 range. You know these lines have been here for a while. I didn't add these today to be like, haha, see, look, I have like these lines have been here for a while. Then it crashes, guess to where? Oh, wow, 178 bounce and plays literally within this trading range. I'm actually just noticing this right now because I didn't pay attention to it too much today because I didn't have calls on it today. So I'm like, oh, how convenient. You know, now in hindsight, I'm like, it's perfect. Bounce, 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 bounce. Over here, bounce, bounce, bounce. These are some pretty gnarly lines. This purple one, I think I did some random day trade with it. Usually you want to pay attention to my yellows, which are like, these are pretty decent, and my blues are usually the strongest. Sometimes if I like see something intraday, I'll throw a purple down, but I need to just get rid of those and just stick to these 2 colors. Otherwise, we're going to start looking like the rainbow. But this is crazy. And then when we fell out of that range, we couldn't get it back up. We kept getting rejected there. So TA is not Fugazi. It's pretty straight up. Like, this is what happens. The reason this happens is because a lot of people look for similar trends. And it's sort of self-fulfilling in that sense. Anyway, okay, so Fed being pissed off is getting priced in. Obviously, consumer sentiment was like poopy-doopy this morning on the consumer sentiment numbers, and the inflation expectations were higher. But they shouldn't be because inflation is falling. Unless, of course, this one inflation report was just an outlier, and we're not going to go back to like good inflation reports. I don't believe that, but it is a possibility. And then you have stagflation. But overall, my point of view, and I'm going to play my Yahoo Finance interview here, but overall, there's something going on. Too many things are starting to crack, and you're starting to see the VIX go up. That's your volatility index. In fact, look at the day chart here. Yeah, but you're barely going up. So this is the week chart on the volatility index. It's been straight down on vol. On the day chart, you're pretty dang low on volatility still, but something is starting. This is the non-average candlestick. Let me go to the 1 hour. Something's starting to brew. 1 hour still. It's too hard to really see that there's anything yet. I mean, all I know is the VIX was up 6% today. But I wouldn't be surprised to see this have another little leg up. I mean, certainly before the election. You know, stocks almost always sell off before the election. But anyway, I don't know exactly what's going on. I know risk assets are most at risk of a sell-off here. There's some weirdness going on where NVIDIA and probably, honestly, indexation is just propping up the market. Indexation is a problem. Indexation is a problem because you just continue to allocate to stocks that are going up, without much, in my opinion, fundamental thought. Actually, zero fundamental thought in indexation, but whatever. Apple's doing well, but not as well as I thought. I thought we were going to go over 250 pretty soon. The trend started dying within the last couple days here. Now, I made money on Apple, but I also had some trades that were red on Apple, but my net up. So, look, if you want all my buy-sell alerts, I send them in my Stocks Insight group. I send you my theses. If my thesis is wrong, I show you, like, here's how I'm flipping on it, whatever. Like, yesterday I was shorting coin. If I didn't get stopped out on it, it would have been really good today. So I did take a little bit of it. I think I was down like 6K or whatever, which is a big deal. But, it would have paid out really nicely today. But my stop loss triggered. And usually I don't set stop losses. But I was playing with this new feature on Webull. It's stupid. Because if I kept it, I would have been up quite a good chunk today. But that's okay. Woulda, coulda, shoulda. Don't do woulda, coulda, shoulda. So again, Fed, pissed off because of the Fed. A lot of cracks in the economy that the Fed may not be paying attention to. Therefore, you are getting this environment where interest rate sensitive stocks are going down at the same time as bond yields are going down. You're at 4.22 on the 10-year. So it's like, oh, that's weird. Usually when yields go down, risk assets go up. Yeah, exactly. And then I'm just pulling here. If we're at 4.22 on the 10-year and on the 2-year, we are at 4.7. Oh, wow. We just inverted more. Wow. 48 basis points inverted. We just went up another 8 basis points. We're going deeper into inversion. Well, that sort of corroborates what we're saying here. Greater risk of recession. That's what's being priced in. This is why I haven't gone full bull. A couple days on Wednesday after the Fed meeting, I'm like, okay, these CPI numbers take me from like a 4.5 to a 6.5, along with PPI and the other numbers that we're getting. But 6.5, even to 7, is still a D or a C on the bull scale, like low. So these cracks, it's just gonna be a matter of time to see how bad they end up being. Anyway, if any of this makes you nervous, get yourself up to $200 free by signing up for an account with Coinbase. Go to metkevin.com/Coinbase, paid promotion. Get yourself life insurance in as little as 5 minutes. Go to metkevin.com/life. Sign up for Webull, also paid promotion. Sign up for Webull, get up to $3,000 when you open an account at Webull. metkevin.com/Webull, also paid promotion. And check out the coupon code over at kevin.com. Thank you so much. And that coupon code is .plot. .plot is what we're calling that right now. And we'll see you in the next one. Thanks so much. Goodbye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than Househack, nor am I presently acting as a market maker. Make sure if you're considering investing in Househack to always read the PPM at househack.com.